If you want to learn more about the smart way to distribute funds from your portfolio in a down market, then you're going to want to watch the rest of this video. I'm Stephen Rashaw along with my co-host Neil Frankel, and this is The Smart Money Show. Welcome back, and thanks for tuning into The Smart Money Show. I'm your host, Stephen Rashaw, along with my co-host Neil Frankel, and today we're going to be talking about the things you need to know and think about when it comes to distributing money from your investments when the market's not doing so well. So Neil, this is something that comes up every once in a while, especially in times like these when there's some stress on the market. What's one of the first things you think about when, we're advising clients on how should they be thinking about and taking funds, if they need to, from their portfolio in a down market?
Well, there's a couple of things. The first thing is to acknowledge your feelings. I mean, it's scary as hell when you've worked all your life and you no longer have a paycheck, and then you're relying on your assets to create the income. So, you have to acknowledge that. And the reality is that almost everybody that we work with is going to have to confront this problem one time or another, because you could be not retired. You could be thinking, oh, you're going to retire in a few years, and the market drops and you're worried about it. Or you could retire, the market's great, and then 10 years from then, after you're into retirement for 10 years, then the market drops and then you're worried about it. So everyone has a longer term. The good news and the bad news is you have a lot more time than you think. So what I'm trying to say is, on the one hand, because you have so much time, you're probably at some point in your life going to encounter this problem. But on the other side is, the day that you retire, you don't need all the money at one time. You don't need it all at one shot. You need the money to create income for the rest of your life. So if it's down at one point during that retirement period, it's uncomfortable, and you can acknowledge that, but it probably won't have an impact on your overall lifestyle.
Yeah, that's a really good point, right? It's not really an all or nothing approach. You don't normally need all
Right.
of your money. Same with your investment portfolio, right? You shouldn't be all in one type of asset class or one stock or one investment. You should have some diversification. One thing, Neil, you and I were talking about the other day, and you were oftentimes talking about with clients, is portfolio asset allocation and diversification. So one thing to think about on the front end of all this is how much money in your portfolio is allocated to some of the safer things like cash equivalents, treasuries, fixed income. So a rule of thumb, right? Not for everybody, but the rule of thumb as a guideline when you're designing a portfolio, you should have at least enough fixed income and cash equivalents in that portfolio as a percentage to cover about 1 to 2 years worth of living expenses. So think about that. Some math here. If you have a $500,000 portfolio, and let's just say that your monthly living expenses are about $10,000 a month, so $120,000 a year, give or take, you should have about 25 to 50% of that portfolio in fixed income. That's going to give you at least 1 to 2 years worth of living expenses covered inside of your portfolio in the event that you do need to take a distribution.
Right. So I just want to sharpen that a little bit. So what you're saying is, I think, that by having enough fixed income or equivalents in a case of a bad market, you could tap into that money, the more conservative things, and give your more aggressive equity investments more time to recover. Is that pretty much what you're saying?
Exactly. Yeah. In fact, I just was asked the other day by CNBC. I just put the quote up there on the screen, and that's exactly what we were talking about. Is, hey, consider selling your fixed income and cash equivalents first before your stocks. Give those stocks more time to recover. You were spot on about that, Neil.
Hold it. Why did CNBC call you and not me? I don't get that. What's up?
We're gonna have to call the producer over there and see. We'll have to get him to schedule you next time, Neil.
Yeah, come on. You know. All right. Anyway, but and getting back to this issue of conservative investments and the amount that any one client, I really like that you said it was a rule of thumb, and it's a starting point to discuss it. It's not an execution point, because look, if there's a client that's got an income that's coming from a government pension and it's more than they need, they may not need as much, to be so liquid, so to speak. On the other hand, if you're going to be buying a house or some other large expense to take care of, you might need more cash. So this is a rule of thumb, and never actually build your life around rules of thumb. That's what really we're here to do, is to help you go through it and apply that to your own situation. I've never seen two people with the exact same cash needs, and I've been doing it for 30 years. So
Yeah, that's totally true. Everyone has a unique situation. It's specific to them and their needs. And I think that mostly wraps it up, Neil. What would you say are kind of the three main takeaways here?
well, there is one other thing. Sorry. One thing we didn't talk about is um, what I've experienced with many of our clients is that they get to their focused or their stated retirement age, and then they realize, you know what? I don't want to retire. I want to work part time. I want to do something else and make a little bit of cash anyway, whatever. A lot of people are that way. A lot more are that way than not. So what I'm saying is, if you reach a point where you retire and the market is down, and you've considered, tapping into the more conservative investments first and allowing the other stuff to recover, you could also think about possibly, if you want to, extending your working career or considering working part-time, because you might want to do that anyway, and that would reduce the strain. So I guess in summary, Stephen, what I'd say is, in terms of takeaway number one, there are a lot of solutions. In 30 years, I have never had a situation with a client where we said, well, looks like you're going to have to move in with the kids and start liking Purina cat chow. That's never happened, and it never will. There's lots of solutions, lots of ways to resolve a problem that in most cases is temporary. The second thing is, we don't know how long the current decline that we're talking right now in the midst of the COVID-19, but there will be other declines going forward. And we don't know how long this is going to last or how future declines will last. But there's really no reason to get worried or anxious. What there is something to do is come and talk to us and revisit your retirement income plan. That's an important takeaway. And by the way, I think that's the good takeaway for good times and bad.
Yeah, I mean, I couldn't have said it any better. I'm glad I had you say it for me. Hey, if you like this video, give us some love. We'd love to hear back from you. Send us your comments. Actually, you know what? We'd like to know what other topics that you want to hear about. So send us your questions. Give us your comments and feedback. We'd love to hear it. If you learned something new, be sure to share this with your friends and your loved ones. They probably have a lot of the same financial questions and thoughts that you do. And until next time, I'm Stephen Rashall, along with my co-host Neil Frankel, and we're helping you get smart with money.